Today, we're going to be talking about something big. There's warning signs that always show up before every real estate crash every single time, and a lot of those signals are here again right now. I'm Chancey with Real Broker. Make sure to hit that like and subscribe button. Would really appreciate it. So most people don't recognize these signals until it's too late. But if you understand what's happening, you can position yourself ahead of the next major shift. Near the end, I'll explain the Canillan effect, which is one of the biggest reasons why regular buyers feel like they can never catch up. Once you see it, you won't be able to unsee it. So let's start with the housing signals. Right now, we're seeing the same pattern that show up before every correction. We've got over-leveraged buyers, stalled pre-sale projects, developers are pulling back, investors have basically vanished and left the country, inventory is climbing, and sales are dropping. Government solutions like increasing insured mortgage limits to $1.5 million or removing GST for first-time homebuyers, these aren't random policy changes. These are reactionary moves that typically show up when something underneath the market is starting to break. So let's look at the numbers. In May 2025, Vancouver hit over 17,000 active listings, which is a 10-year high, and condo inventory alone was over 7,300 units, and that doesn't even include the shadow inventory that developers have. Also, sales volume fell 30% below the 10-year average. That's massive. These are not seasonal slowdowns. That is demand absolutely disappearing. The sales to active listing ratio sits around 13.4%. Technically, that means it's a balanced market, sure, but in practice, this is acting like a buyer's market. And in specific markets, those numbers are even worse. In South Delta, in the last 30 days, the sales to active listing ratio was around 5%. Now, historically, in this line, that's where prices start to slide, and we've already seen that this year in 2025. Now, remember this. Prices don't crash when buyers disappear. Prices crash when everybody tries to sell at once, and we've seen basically every single investor leave the market in BC and either save their money, put it back into their primary residence, or they're investing outside of the country. I'm not saying the market's completely crashing right now, but I think we're closer than people realize. So let's zoom out, because real estate doesn't crash in isolation. The broader economy always paints the picture about what's coming. So let's talk about inflation first. In May, Canada's CPI held at 1.7%, but core inflation was closer to 3%. June CPI was expected to tick up again, driven mostly by food and shelter. Why does this matter? Because inflation inside that 3% range forces the Bank of Canada to keep rates higher than people want. Luckily, we've seen a couple rate reductions because the economy is actually worse than what was predicted. When rates stay high, borrowing stays expensive, and comparatively speaking to the last 10 years, rates are higher than we have seen on average. So that means households are getting squeezed, we're not spending as much, and eventually the cracks show up in real estate. Interest rates are the next major piece. The Bank of Canada held its policy rate back in June, but then we've seen a rate reduction since then. Interest rates are the next major piece. The Bank of Canada held its policy rate back in June at 2.75%, and then since then we've seen another couple of rate reductions. But the thing is, fixed rates haven't really been budging at all. There's hundreds of thousands of mortgage renewals coming up over the next year. Mortgage renewals coming up are absolutely crushing people. If you've been in a 1.8 fixed rate for the past 5 years and now you have to pay something around the 4%, your payment is basically double. And that's even if they can renew. The payment shock wipes out any wiggle room. And this will show up later in the year as slower spending, more debt stress, and pressure on prices. Yes, the market expects some more rate cuts, but delays in cutting rates might make things worse in the short term. It squeezes credit and shows the economy even more. Now let's move on to employment. In June, we added over 83,000 jobs, but most of them are part-time, and that's the same thing we're seeing again right now in the fall. Unemployment dropped to 6.9%, but the PMI employment index fell below 50%, which signals contraction. These jobs are not those that support a $900,000 mortgage. These are survival jobs, not growth jobs. Next, consumer confidence. The Consumer Confidence Index is stuck at 48.8%, below the neutral line of 50. Canadians simply aren't optimistic right now. The pessimism is adding up with every single buyer in the market right now, including those that I'm working with. I have countless buyers that are currently in rentals waiting to buy, and they're just not pulling the trigger on any properties, even if they absolutely love it, because they consider the market because they think the market's going to continue to slide over the next 6 to 12 months, and I agree. Combine that with a wage to debt problem. Wages grew 3.2% year over year, but household debt is among the highest in the entire world. That's not just the G7. And mortgage debt is nearing $2.2 trillion. So basically, there's no cushion left. There's no wiggle room. Any rate change up or down hits like a hammer. Now, let's look at some leading indicators. The Canadian Recession Probability Index is projecting an 84% chance of recession within the next 2 quarters. These models have correctly predicted previous downturns, and right now they're flashing bright red with a strong indication that we are in a recession or headed that way. This is where economic philosophy matters. If you look at this through an Austrian economic lens, you see the pattern clearly. Real estate bubbles can form because of artificial credit expansion and cheap money. For decades, central banks have lowered rates, printed money, and expanded credit. This creates artificial demand, inflated prices, and eventually a correction. Think of the Paul Volcker era. In the early 1980s, after years of reckless monetary policy, rates were pushed above 19%, and the housing market absolutely froze. Prices corrected sharply. It was painful, yes, but it broke the back of inflation. Sure, housing prices were significantly lower than they are today, but it still hit every single person out there. Then came quantitative easing, 2009, 2020, and 2021. Massive amounts of new money flooded into the system, and that money flowed straight into assets, especially housing. Since COVID, money expansion has averaged around 8 to 9% per year, add inflation at 3%, and your real purchasing power is dropping around 11% annually. Over a decade, that can wipe out 80% of your buying power. That's just absolutely crazy to even think of. This is where debt to GDP numbers start to matter. Canada's debt to GDP ratio is hovering around 110%, levels we haven't seen since World War II. Except this time, there's no war. It's just due to overspending and declining productivity. Every interest rate hike pushes us closer to a fiscal wall. Now, let's talk about the Canillan effect, because this explains why everything feels harder for regular buyers. Richard Canillan observed that when new money enters the system, the people who receive it first benefit the most. They get to spend it before prices rise. Banks, governments, large corporations, asset holders, they're all first in line to benefit from this. But as that money circulates and prices rise, the last people to get it, wage earners, fixed income houses, young buyers, they get absolutely crushed. By the time that money reaches them, prices have already inflated, their savings buy less, their wages fall behind, and housing moves further out of reach. Sound familiar? It's a big reason why the wealth gap has exploded, and it's a major force behind our housing crisis that we're dealing with right now. Okay, let's recap everything. Inventory is rising, sales are dropping, prices are slipping, inflation is sticky, rates are high, employment quality is weakening, wages are not even keeping up at all compared to the cost of living right now, consumer confidence is low, debt is overwhelming, recession indicators are flashing bright red, and credit conditions are deteriorating. These are all classic conditions that show up before a correction. So what happens next? History gives us 3 scenarios to look at. Scenario 1, it's a slow bleed, prices drift down, sellers capitulate over time, sentiment sinks, everybody gets worn out emotionally. Scenario 2, there's a sudden drop. A shock hits, a credit squeeze, layoffs, or a liquidity crisis. Prices fall fast. This is one of the most painful because it's so quick. Scenario 3, soft landing. Rates ease, inflation cools, the market stabilizes. This is the story we're being promised right now, but the fundamentals just don't support it yet. So what do? If you're a buyer, focus on the fundamentals, block out the noise, only buy if the numbers make sense today, not based on future hope. If it doesn't cash flow and you're an investor, walk away. You have an opportunity right now also to negotiate harder than you ever have before because everything's on the table right now. If you're a seller, you need to price ahead of the trend, not behind it. The worst thing you can do right now is overprice your home and then do small price corrections over the period of your listing. Keep trying to chase the market because you're going to end up with less in your pocket than if you just priced your home correctly in the first place. Otherwise, you're going to be selling at the bottom. You need to get in front of the curve, sell it quickly, offer incentives if needed, make sure your home is showing at its absolute best, get a strong marketing package, and make sure that your realtor's putting in the work to help get your home sold. If you're an investor, a wave of new purpose-built rentals are coming and it's going to push rents down even further. So if you're on the sidelines, stay liquid, save cash, watch the signals. Don't look at all the headlines. When panic hits, that's where your opportunity lies. The fear and greed index is at all-time highs right now, so there's great opportunities out there, but you always need to look at real estate as a 5 to 15-year investment. If you're in a rental right now and it's a super affordable rate, stick it out because there's going to be great opportunities coming soon. Finally, whatever you decide to do, work with someone who understands these cycles. Someone who's lived through the foreign buyer tax shock back in 2016, the COVID roller coaster, and corrections before that. If you follow the signals instead of the noise, you're going to make the right moves. I'm Blake Chancey with Real Broker. Thank you so much for watching. Make sure to like and subscribe. I'll see you on the next one.